Hello friends, today I am going to talk about intercompany reconciliation. Intercompany reconciliation is one of the critical activity which need to be performed during the month end. This activity is generally done by the P2P team. In certain companies, it's performed by R2R team. In this video, I am going to explain you the meaning of intercompany reconciliation, the reasons behind the mismatch between two entities, and at last I'll explain you how to perform the reconciliation and what are the reconciliation entries to be posted to ensure that there is no difference between two entities. So if you are new to this channel, I would request you to subscribe so that you get more updates in future. So let's begin. Let's understand what is the meaning of intercompany reconciliation. Intercompany reconciliation reviews and matches transaction. This word is very important. Matches transaction. Okay. Between different entities within the same corporate group, or you can say related parties. And what you are going to match? Ensuring that all amounts are recorded correctly and consistently. So if you see this definition, it is very clear that you have two legal entities, okay, and both are related parties. And what you are going to do, you are going to match the transaction of one entity with the transaction with another entity. Any discrepancies between these two companies' transactions has to be posted, or accounting entry has to be posted to ensure that two balances are reported correctly, right? It's not happened that one company shows receivable of 1 lakh and the other company shows payable of 50,000. You can't have a difference of 50,000 rupees here, right? Let's understand more about the definition. Intercompany reconciliation is the process of verifying transactions between two units or subsidiaries of the same parent company, ensuring the financial records of related parties or companies are in agreement, identifying and correcting discrepancies, right? So this is all about intercompany reconciliation. Now let's understand what is related party. So parties are considered to be related if one party has the ability to control the other party or exercise significant influence over the other party, directly or indirectly, in making financials or operating decisions, right? So whenever there are two legal entities and these two legal entities are related party to each other, then the transactions data of one company and the transaction data of another company has to be reconciled to ensure that both shows the same number of amount, either receivable or payable, but it should match, right? You can't have mismatched numbers. Now let's try to understand what is the need of intercompany reconciliation. Why a company should perform this reconciliation? What benefits the company is going to get by doing this reconciliation? Because if you know the need of this reconciliation, then we'll understand that how to perform this reconciliation and what reconciliation entries to be posted, right? So intercompany reconciliations ensures that two related entities records all transactions in their books so that there is no mismatch between the entities. So the objective of this reconciliation is very clear. Two entities, their books should match. So whatever transaction is there in one company, the transaction in the other company should match. That is the main objective of the intercompany reconciliation. Why transaction has to be matched? What is the need of that, right? Let's understand. The holding company will face challenges to prepare consolidated financial statement as the transactions are not accounted correctly by its subsidiary company, right? So when the holding company will merge all the subsidiaries in their books, okay, while preparing the consolidated financial statement, if one of the company has not accounted the transaction between the holding company and the subsidiary company, then you can't match, right? Because one pocket to other pocket, the flow of the transaction has to be matched, right? One sided, you can't have entry. The intercompany transaction has to be eliminated while preparing the consolidated financial statement. The holding company can't earn profit from its subsidiary as both are one company, right? So, if the holding company has raised an invoice to the subsidiary company has to record that expenses so that the income earned by the holding company and the expense reported by the subsidiary company can be knocked off so that they don't earn profit by selling to the subsidiaries. That is the main objective, right? Now, let's take an example. ABC Limited, who is the holding company, the profit and loss account you can see here, service income from XYZ, okay, and XYZ is the subsidiary company. So service income, that means the invoice raised by ABC Limited is 10,000 rupees. At the same time, XYZ, who is the subsidiary, is recording that invoice as an expense because XYZ Limited has to pay to the holding company ABC. So professional fee account debited 8,000 rupees, right? Now, what's happening here? When ABC Limited will prepare the consolidated financial statement, because the holding company will prepare the consolidated financial statement, right? Merging XYZ profit and loss account with ABC profit and loss account indirectly to understand what is consolidated financial statement. The service income from XYZ limited has to be eliminated, and in this case it will not get eliminated fully, as rupees 2000 not accounted by XYZ. So in this example, what has happened? ABC has raised the invoice for 10,000, whereas XYZ has accounted only for 8,000. So there is a mismatch, right? This 2,000 rupees not accounted by XYZ could not be eliminated because there is a difference between both companies, right? So what will happen? So there is a short expense booked by XYZ and your consolidated financial statement will not match. So you have to post this 2,000 rupees entry to ensure that there is elimination and the balance sheet matches. Now let's try to understand the reasons for mismatch between two entities. Why there will be difference between two entities? If we understand the logics or the root cause of this reason, then when we do the reconciliation, we can pass necessary entries. So understanding these reasons are very important. The first one is invoice not received or not accounted. If the invoice is issued by one company and is not accounted by other company, then there will be mismatch in the accounts. Okay, let's take an example. XYZ Limited raised invoice for IT service invoice on ABC Limited on 2nd February 2025. The invoice, the hard copy, was received by ABC Limited IT team on 19th February 2025. IT team took 1 week time to approve the invoice and was handed over to finance team on 26th February 2025. The finance team could not account the invoice by 28th February as there were other high priority invoices to be accounted, right? In this case, the IT service invoice will be considered as mismatch item while performing the intercompany reconciliation. Why? Because XYZ has raised it, he has recorded in the books of accounts, whereas ABC has not recorded in the books of account. So what will happen? XYZ, which is a holding company, for example, will show a receivable of one X amount relating to the IT service invoice, whereas ABC Limited will not show any payable amount to XYZ. So there is a mismatch, and hence there should be a reconciliation entry to match both. Second point, invoice received for material purchased and only GRN entry posted. Okay, very important while doing this reconciliation. Okay, if the invoice is issued by one company and is not accounted by other company, then there will be mismatch in accounts even though the GRN entry is posted. Okay, and GRN entry is generally posted in case of material purchase, right? So let's take an example. When you receive the material, what entry you're going to post? The GRN entry will be inventory account debited to GRIR. And generally this is done by the logistic team. They validate, they approve in the system, and system posts this automatic entry, that is inventory to GRN. Now the day you are preparing a financial statement, only this entry is posted in the books. Whereas the second entry, when you do your invoice processing, only then it will be posted, that is GRR account debited to vendor account, and this is done by the finance team. So now the invoice is not received by the finance team and this entry is pending, only the GRN entry is posted. But in the GRN entry, whether you have a credit to the vendor, the answer is no, right? It is just like an entry to the clearing account. So if only GRN entry is posted, then the liability is not credited in the vendor account. Hence, there will be a mismatch. End of the day, you are not crediting to your vendor. Hence, the vendor balance reported in his statement and the vendor balance in your statement will have a mismatch. You have recorded the amount at the time of GRN, but that amount is reflecting in another GL, that is GRR account, not to the vendor account. Third point, payment made not accounted by other company. So this is very clear. One company is making the payment, the other company is not recording it. If you will not record, obviously that transaction will be shown as outstanding, right? So if the invoice payment is made by one company, but the same has not been accounted by other company, then there will be a mismatch in the account. Let's take an example here. XYZ Limited made payment of rupees 10,000 to ABC Limited for invoice number A256/2025. But the payment received by ABC Limited is not accounted by ABC Limited. There could be any reason, but we are not talking about the reason why it is not accounted. But the situation is that ABC has not accounted it. This will result in mismatch between both companies as XYZ Limited will clear the invoice as payment made to ABC Limited. Correct? Because XYZ has released the payment. So he will clear that invoice. He will not show any liability to ABC. Whereas ABC Limited will still be showing amount received from XYZ Limited because ABC has not posted the payment entry. Coming to the next point, payment made after deduction towards TDS or damages but not accounted by receiving company for the short payment. Let's take an example here. XYZ Limited accounted the invoice received from ABC Limited towards consultancy fees. The invoice value was 1 lakh. As per Income Tax Act requirement, XYZ Limited deducted TDS at the rate of 10% and transferred net amount of rupees 90,000 to ABC Limited. ABC Limited accounted 90,000 and still shows 10,000 receivable from XYZ Limited instead of posting TDS receivable account. This will create mismatch between two entities. So what an entry XYZ is going to post when he gets the invoice, the entry will be professional fee account debited 1 lakh, to TDS payable 10,000 because he has to deduct 10% and remit to the government as per the Income Tax Act requirement, and to ABC Limited 90,000 because 90,000 will be paid to ABC, right? Now, what actually ABC should account? ABC should account bank account debited 90,000, TDS receivable account debited 10,000 to XYZ account 1 lakh. Right now, if ABC makes a mistake here, instead of posting the TDS receivable account debited, only post an entry that is bank 90,000 to XYZ 90,000, then still ABC will be showing receivable of rupees 10,000 from XYZ, which is not correct. So that is a mismatch which will be there. If ABC Limited doesn't post the TDS receivable entry, then there will be a difference of rupees 10,000 between both book of accounts. Next point is wrong clearing of invoice. So if the payment is cleared with wrong invoice, then both entities will have mismatch to the extent of wrong invoice cleared. Let's try to understand with an example. XYZ Limited made payment of rupees 10,000 to ABC Limited for invoice number A256/2025. But the payment received by ABC Limited is cleared with invoice number A257/2025. Both invoice value was of same amount, that is 10,000. In this case, XYZ Limited will show payable outstanding for rupees for invoice number A257/2025, whereas ABC Limited will show receivable pending from XYZ Limited for invoice number A256/2025. So what is happening? There is a wrong clearing. Instead of clearing with A256 invoice, the company has cleared with A257/2025, right? So even though there will be no mismatch in amount, but there will be mismatch for the outstanding invoice, right? So we should be very clear that we clear with the right invoice. Otherwise, one company will show receivable for one invoice, whereas you will be showing as payable for another invoice. Next one is very important, foreign vendor not restated, right? Let's take an example. All foreign vendors where invoice received in foreign currency and accounted in foreign currency has to be restated as per the closing rate on the date for preparing the financial statement. If it is not restated, then the INR converted into foreign currency will be different than invoice value. You will get more clarity when I talk about the example now. For example, XYZ is accounting an invoice and the invoice was in foreign currency, that is in USD. So the invoice value was $1,000 and on the date of accounting, the conversion rate was 80. Hence the entry posted by XYZ was professional fee account debited 80,000 to ABC Limited 80,000. Right now, what is happening here? On 31st March, this liability is not paid. So what he has to do, XYZ, he has to restate this liability. What is the restate amount here? Unrealized forex loss account debited 5,000 to ABC Limited 5,000. Why 5,000? Because on 31st March, the rate, the conversion rate of USD was 85 rupees, whereas it was accounted at 80. There is an incremental liability of 5 per dollar, right? So 1,000 into 5, 5,000 rupees is the extra liability you are creating here. Now question is, if you don't restate this, what is going to happen? So if the restatement entry is not posted, then the USD payable reported will be 80,000 because that is what is recorded on the date of processing the invoice divided by 85 because on 31st March the rate is 85. So when you are reporting this number on 31st March, it will be divided by 85. And what USD you are getting here? 941 USD, which will create again mismatch between the entities because the entity has issued an invoice for 1,000 and you are recording at 941. So you have to restate. If you are not restating your liability, then there will be a mismatch. Now we are coming to the important part of this video, that is the preparation of reconciliation. How do we reconcile? Okay. Let's take an example here. Below are the payable and receivable statements from ABC Limited and XYZ Limited. So XYZ Limited is the holding company here in this example. Prepare the reconciliation for ABC Limited and XYZ Limited and pass necessary accounting entries. So what we are going to do now, we'll do the reconciliation in the books of ABC Limited. We'll do the reconciliation in the books of XYZ Limited, and we'll see what rectification entry the both companies are going to post to ensure that the balance of both are matching, right? So here is the statement of XYZ Limited, the holding company. So what you see here, there are four invoices which is raised to whom? To ABC Limited, right? So you have 1231 invoice number, and it is for consultancy fees. The amount is 50,000. 1311, it is sale of inventory, and the invoice value is 1 lakh. 1378, rental income 2 lakh 40,000. 1398, travel cost reimbursement 10,000. So the amount what you are showing as receivable from ABC is 4 lakh rupees. Now let's see what ABC has recorded. So ABC shows a payable amount only for one invoice, that is 1231 consultancy fees 45,000 rupees. Okay. Why? Because TD is deducted at the rate of 10%. Now question is, what about the remaining invoice? So you have some notes for the remaining invoice. For invoice number 1311, material received at factory and only GRN entry posted, invoice not submitted to finance. As invoice is not submitted, hence ABC statement doesn't reflect that invoice, right? Invoice number 1378, payment was made on 28th of February. So on 28th of February, 1378 invoice number has been paid, hence that is not getting reflected in the statement of ABC. Invoice number 1398, that is for the travel cost reimbursement, not yet received by Avis Limited, hence it is not accounted. So what you see here, you see four invoices raised by XYZ and shown as receivable from ABC, and on the other side ABC shows only payable for one invoice, and for remaining three invoices there are some comments. So let's start with the reconciliation. We'll start with the reconciliation by ABC Limited first, then we'll do XYZ. So while doing the reconciliation, always ensure that each and every invoice has to be matched. So when you have statement from XYZ Limited, ensure that every line items is matched and the reconciliation is prepared. So if you see the reconciliation here, payable outstanding to XYZ Limited is 45,000 rupees. So you will start with the amount what is reflecting in your accounting system. And in your accounting system, the amount shown payable to XYZ is only 45,000 rupees. So you start with that, right? Then add. Why add? Because there are certain differences which you need to add so that you match with the statement of XYZ Limited. What you're going to add? TDS amount not recorded by XYZ Limited. So you are adding here 5,000 rupees, right? Because you are reporting only 45, you have not recorded the remaining 5 because the remaining 5 is parked to TDS payable account. So you add this 5,000 rupees here. Next, inventory received and GRN made. So this also you have to add 1 lakh because you have not recorded, right? So you have to show as adding so that your liability increases and it matches with XYZ. Payment made not accounted by XYZ, right? You have made the payment, but XYZ has not accounted. So to match to hitch receivable, right? You have to increase your liability now 2,40,000. Invoice not accounted. Again, you have to increase your liability by 10,000. So what is the total adjustment you have here? 3,55,000 rupees. Now, if you add 45,000 with this 3,55,000 rupees, you will end up with 4 lakh, which will match with the statement what XYZ has provided to you, right? So XYZ is showing 4 lakh receivable. Now, after this reconciliation, you are showing that you are going to pay 4 lakh to XYZ. So it matched. Now, whether I need to take action for each and every line item, what I did adjustment here, the answer is no. So if you see the remark part, accounting entry required, so for TDS amount, whether entry is required, the answer is no. Why? Because XYZ Limited need to account. You have deducted correctly and you are remitting to the government. So you need not go and reverse that entry. It is XYZ who should post the entry and rectify in his book. So you are not going to take any action. Inventory received and GRN made. So what has happened here? The entry is posted, but it is in the GRN account. So you have to post another entry to make it credit to the vendor account. So you need to post an entry. Payment made not accounted by XYZ, it is not your problem. You have released the payment. It is XYZ who has to adjust in his book. Okay, so XYZ has to post the entry. You need not take any action for this line item. And the last one is invoice not accounted 10,000. In this case, you need to post the entry because you have not created the liability. So what are the reconciliation entries you're going to post here? For the first one, inventory GRN entry posted, only invoice entry pending. Here the entry we are going to post is GRI account debited to XYZ Limited 1 lakh 1 lakh, right? And travel cost invoice not accounted, you are going to post entries travel expense account debited 10,000 to XYZ Limited 10,000. In certain companies, they don't directly post the entry in the vendor account. They will have a clearing account which is mapped to these related parties. So you can post these entries and then reverse on next day, that is in the next following month, so that when you get the real invoices, you post that. But this will be the adjustment entries which will be posted to ensure that your liabilities and the receivables shown by the other company matches. Now let's see, after posting the reconciliation entries, what is the final amount ABC Limited is reporting in the books of accounts. So payable outstanding to XYZ Limited was 45,000 rupees. This is before posting the reconciliation entries. Now two entries posted as part of the reconciliation. The first one is inventory received and GRN made, right? In that case, 1 lakh rupees entry is posted, that is credited to XYZ now. Then invoice not accounted for the travel cost, that one also we are posting an entry for 10,000. So total adjustment or total liability increased is 1 lakh 10,000. So net payable to XYZ Limited after the reconciliation entry is 1 lakh 55,000 rupees. And this is where ABC Limited will close the reconciliation. Now let's see how the reconciliation will happen in the books of XYZ Limited, right? So this is the reconciliation what XYZ is going to do. Receivable outstanding from ABC Limited is 4 lakh. So this is as per the books of statement of XYZ. Less TDS amount not accounted 5,000 rupees, right? This is the part reconciliation what XYZ is doing it now. Sales of inventory not accounted by ABC Limited, so less 1 lakh. So you are reducing your receivable because the other company has not recorded, right? You are trying to match with his books first. Then we'll decide the reconciliation entries. Payment made by ABC Limited not accounted, 2 lakh 40,000 rupees, right? You are reducing it because if you account, then automatically your receivable will come down. Travel cost invoice not accounted by ABC Limited, 10,000 rupees. Again, here also you're reducing your receivable because the other company has not accounted the invoice. So what is the total adjustment you have? 3 lakh 55,000, and the net receivable outstanding is 45,000 rupees. So here this 45,000 rupees is reported by ABC. So you matched that 45 with your 45 reconciliation, and this is the reconciliation sheet what you have prepared. Now question is whether you need to post entry for each line item. The answer is no. So TDS amount not accounted, invoice number 1231, the 5,000 rupees, you have to post that entry. Sales of inventory not accounted by ABC. So you have done the sales. ABC has to account it. You need not take any action. So no action to be taken here. Payment made by ABC Limited not accounted. So it is your mistake that you have not accounted this entry. So you have to record it 2,40,000 rupees. So entry has to be posted for that. Travel cost invoice not accounted by ABC Limited. This is ABC who need to account it. So ABC will account it. You need not take action on that. Right. So what is the reconciliation entry you are going to post now? For the first one, TDS directed by ABC Limited to be accounted. So you will be posting an entry TDS receivable account debited 5,000 to ABC Limited 5,000. And for note 2, payment received not accounted, you are going to post entry bank account debited 2 lakh 40 to ABC Limited 2 lakh 40. Now let's see, after posting the reconciliation entry, what is the net receivable XYZ company is going to report. So here receivable outstanding from ABC Limited was 4 lakh. This is before the reconciliation entry, right? The statement what I showed you in that slide, in the first slide. Less TDS amount not accounted, right? Because this 5,000 you are not going to get it from ABC. So you have to reduce this TDS amount. So from 4 lakh, this 5 lakh will be reduced. Payment made by ABC Limited not accounted, 2 lakh 40,000 you have to adjust, and the total adjustment is 2 lakh 45,000 rupees. And what is the net receivable you are showing from ABC now? After all these adjustment entries, it is 1 lakh 55,000 rupees. Now, in books of ABC, the amount showing is 1 lakh 55. Now in the books of XYZ Limited, the amount showing is 1 lakh 55. So this is how the reconciliation has to be prepared. For each line item, you have to justify whether you need to post the entry or the other entity need to post the entry. Sometime in a practical scenario, there will be challenges to understand that who should post the entry. You should talk to that entity and see that what entries to be posted, right? But you need to ensure at end of the day, the receivable, what you show will be similarly shown as payable by the other company. In the reverse side, whatever you show payable, that company will be showing receivable. So this is all about intercompany and it need to be matched for the consolidation of financial statement. That's it from my side. Hope you like this video. Share with your friends. Ask your friends to subscribe to this channel as well and share this video so that everybody understand what is the meaning of intercompany and how it works. Thank you.